Now, there are very many methods people use to invest their money and to build their wealth. There's nothing that's better than the other. All strategies work in their own way depending on the individual and their personal circumstances. However, there are those who don't even know anything about investing, those who had no idea that you could invest or how to invest. So I thought I would make this video to help those who are unfamiliar with investing get a better grasp as to what it is and how they can start doing that as well. So with that, let's get started. So being an engineer for the past 3 years, I knew about investing when I first started. However, when I was still getting my master's degree, I was an engineering intern, and while I was making good money, yes, I didn't really know what to do with that money. After reading some books and finding some information online, I figured out the best strategy for me in terms of investing. Now, I just want to make a disclaimer. I am by no means a financial advisor, so please take whatever I say with a grain of salt. I am just a random person on the internet, and I have no certifications in this department. This is just information and advice that I got from my own experience and have benefited me the most as an engineer. So we're going to get into it. The very first question you should ask yourself is, how much should I invest? Now, this varies person to person, but the average investing rate and suggestion is 15 to 20% of your annual income. Ultimately, the question about how much you should invest, it doesn't really come into play, because as long as you're investing something, then it will grow over time and you will have more later than what you do now, instead of it being spent or the value of it dropping due to inflation. Ultimately, it's good to just have something to invest every month. The next question is, what do I invest in? Now, there are many different ways to invest your money, but the broad areas are real estate, stocks, and bonds. So those are the main three. However, you can go further into each of these categories. So for real estate, you can invest in commercial buildings or in households or in condos, depending on the building you want to invest in or the land you want to invest in. And then for stocks, you can invest in things like mutual funds, exchange traded funds or ETFs, individual stocks, and also target date funds, where it'll automatically adjust your allocation as you get closer and closer to retirement age. And then with the bonds, you can invest in long-term bonds, short-term bonds, or mid-term bonds. Now, again, it depends on the person, what you prefer and what they'd actually want to do. But most people invest in short-term bonds because they have a higher rate of return in the long run. Honestly, it really depends on what you decide to do. Personally, for me, I invest mostly in stocks and then a little bit in bonds, more like 90% stocks, 10% bonds. And then I don't have anything in real estate currently, but I do plan on venturing out into that area, because studies have shown that the more you diversify your investments, the more chance you have of actually becoming financially independent and having a stable income as you get older. Whichever category you decide to go down, make sure you're still invested in the other two, even if it's just a little bit, like 10 or 5%. And that way all your eggs are not in one basket, so to speak. Now, there are some warnings behind what to invest in, especially with the stocks, that you should be made aware of. So with stocks, there are actively managed mutual funds, and those are the ones that I'd suggest staying away from, mainly because the expense ratio is so high, around 1% or more. Now, 1% may not sound like a lot, but it really is over the long term, especially as you start to build your wealth and you're continuously paying that 1% to the fund, even when you don't have to, and you can invest in a regular ETF or an index fund, which is not actively managed. The expense ratio is much low, around 0.02, 0.03, depending on what you decide to invest in. Honestly, that's something that I would suggest being more aware of, is what is the expense ratio when it comes to investing in these mutual funds, these index funds, whatever they are. So just keep an eye out for that. Now, when you start investing, the next question you should ask yourself is, where do I put this money? The most common are taxable accounts and tax advantage accounts. So for example, your brokerage account would be a taxable account, and then your 401k and IRAs are your tax advantage accounts. Those are the two main places where people put their money when it comes to investing in stocks or bonds. Now, with real estate, people put it into a checking account so that they have access to that money if they wish to buy a property or if they wish to put a down payment on a property. And once that's done, then the money is in the actual property itself. How much you put into each account is once again a preference thing. But I'd suggest putting most of your money into the tax advantage accounts because they're tax advantage. And what that means is if you get any sort of earnings on the stocks or any sort of dividends, those will not be taxed on. However, if you have it in a taxable account like Fidelity or Vanguard, then you will be taxed on that money. You will be taxed on those earnings. So that's something that I personally do is I put as much money as I can into my tax advantage accounts first, and then I start putting it into my taxable account. Especially if you are an employee and your company matches a certain percentage, then hitting that match is something people should do because that's basically free money. And right now, the contribution limit for a 401k is $22,500. So you can put up to this amount into your 401k for the year 2023. Now the contribution limit to an IRA, whether it be Roth or traditional, is $6,500. So again, this is how much you can put into that account for the year. There may be people who may not be able to put in that much because they're not making enough money. They're not making enough to put in nearly $30,000 away into tax advantage accounts. And that is understandable because it is a lot of money. If you're one of those people, then personally I would suggest at least hitting your employer match when it comes to investing in your 401k and still maxing out that IRA, because from what I've read and researched, I believe everyone can put away at least $6,500 a year, or at least save that much and put it into an IRA at the very minimum. The next question you should ask yourself is, when do I sell or buy? Now, there is this quote that says the best time you should buy is yesterday. It shows just how important it is to invest and how you can become financially independent and build wealth quicker when you invest your money sooner. When it comes to when to buy, it doesn't matter. You don't need to time the market. There is no timing it because no one really knows what's going to happen in the next year or even 2 years. It fluctuates up and down. It's very unpredictable. It's just not possible to predict when the market will drop or when it will increase in such a short period of time. Now, over the long period of time, since the beginning of the actual stock market, you can see that it has slowly increased over time. So because of that, you would have more confidence in the fact that the money you invest will increase over the long term, at least 10, 20 years. The longer you have it in there, the better chance you have of having that money grow and compound. When it comes to buying or selling, you should buy as soon as you can and hold on to that stock for as long as you can, or hold on to that property for as long as you can. If you need the money, then hopefully by then you'll have enough money so that any sort of dividends or earnings you receive will cover your yearly expenses. And so you'll never actually have to touch the principal of that particular property or stock. Now, the last question is, do I need a financial advisor? In short, no. Now, the longer answer is a bit more complicated than that. Again, it depends on the person. Some people would prefer having a financial advisor, someone who helps you decide where to invest your money, what accounts to put it in, how much you should save every year. And yes, that is good. However, all of this information is available free, whether it be in a book or an article. There is a lot of information that could be found on the internet, online, in order for you to learn yourself on how to invest and what to invest in, depending on your particular circumstance. And as long as the investing process is simple, such as limiting the amount of stocks, bonds, or property you invest in, then a financial advisor isn't really necessary. However, if you have a very complicated financial situation, then yes, a financial advisor is a great option. Someone to help you personalize your finances. And this could also be good for those who don't really have a good sense of self-control. To have someone who is impartial to the situation, they can give a more honest overview and how to proceed. Personally, for me, I don't have any sort of financial advisor, but again, my financial situation is not complicated. I am just a full-time employee that has been working as an engineer since 2020. So if you decide to get a financial advisor, there is one thing I'd like to note is to get one that charges hourly instead of one that charges a percentage for managing your money. Those ones will rob you of your money. They will take at least 1% of it every year, and they have control of your actual investment, so they make decisions on what you invest in. Personally, for me, I would stay far, far away from them and just stick with the fee-only advisors. So that's basically a broad overview on investing, and if there's anything else that I missed or anything that you want me to go into detail, please let me know in the comments down below. But yeah, I hope you guys liked this video, and if you did, please give it a thumbs up because that'll definitely help the algorithm, and subscribe if you'd like to see more. Thank you very much. Bye.